All right, if you care about money, markets, and where the stress fractures are forming right now, you need to hear this. Because while gold and silver just got slammed in the headlines, something very different is happening underneath the surface, and it's happening fast. Billions in paper value vanished in days, not months. And most people think this was just another risk-off liquidation. But the real signal isn't the sell-off, it's who's buying into it. Stay with me, because I'm going to show you why this divergence matters, how to recognize it yourself next time, and why this move could end up looking obvious in hindsight. If you're watching this now, you're already ahead of the crowd that's still reading yesterday's headlines. Now, before I explain what caused this, let me teach you something that'll change how you see every market move from here on out. Most people don't understand that markets don't actually move on up or down. They move on pressure. Pressure between buyers and sellers, between paper claims and physical reality, between short-term traders and long-term accumulators. Think of it like a crowded theater. The prices you see flashing on your screen, that's just the noise you hear. Positioning is where people are actually standing, and right now, the noise is screaming panic, while some very large players are quietly taking seats near the exits. When you understand this, you stop reacting to price and start watching behavior. And behavior is what tells you what's really happening. So what does that tell us? It tells us that the story isn't in the red candles. It's in who's absorbing supply while everyone else is heading for the door. If this is making sense, drop a comment below and let me know you're following along. So here's what's actually happening, and I'm going to break this down into layers because each one builds on the last. Gold and silver sold off hard as futures markets deleveraged. That's the primary driver. Margin calls hit, risk models flipped, and funds that don't care about metals specifically, they were forced to sell whatever was liquid. These weren't people making informed decisions about gold's value. These were algorithms and risk managers hitting the exit because their position sizes exceeded their tolerance levels. When volatility spikes, leverage gets cut. When leverage gets cut, liquid assets get sold first. Gold and silver are liquid. They got sold. That's the mechanical explanation, and it accounts for most of what you saw in the price action. But here's the confirmation most people miss, and this is where it gets interesting. While Western paper markets were dumping contracts, China's central bank was still adding gold, not slowing down, not pausing, still buying. They're extending a buying streak that's now measured in years, not quarters. 14 consecutive months. No attempt to time the dip. No public drama. No press releases about waiting for better prices. Just steady, methodical accumulation. Now, think about what that means. When a central bank with the resources China has doesn't flinch during volatility, that's a signal. They're not trading. They're positioning. And they're positioning for something that has nothing to do with next week's price chart. And then there's silver, and this is where it gets wild. Physical silver demand inside China hasn't collapsed at all. Retail buyers are still active. Industrial demand is still firm. And with new export controls kicking in at the start of this year, local supply just got tighter. So even as global futures prices fell sharply, local prices inside China stayed resilient. You've got paper markets in New York saying one thing, and physical markets in Shanghai saying something completely different. That's not emotion, that's mechanics. When paper selling overwhelms futures but physical demand doesn't blink, you get a disconnect. And historically, those disconnects don't resolve downward forever. They resolve toward the side that can't print more supply. Now let me show you what most people are missing, because they're too busy watching price. This isn't just about China liking gold, it's about behavior patterns. Long-term buyers don't care about weekly candles. They don't care about technical support levels or moving averages. They care about currency credibility, they care about reserves, and they care about optionality. When volatility spikes and they don't stop buying, that's a tell. And when silver shows stress between physical and paper pricing at the exact same time, that's a second tell. Together, they're a convergence signal. Different markets, different structures, same message. And the message is that someone is treating this sell-off as supply, not as a warning. But here's the part that should make you pay attention. This isn't new. This is the exact same playbook we've seen before, and every time it shows up, the outcome rhymes. Go back to the early 2000s. Gold looked completely dead. Everyone said it was a barbarous relic with no place in modern portfolios. Central banks in the West were sellers. The UK famously dumped half its reserves at the bottom. But emerging buyers were quietly accumulating during that entire period. The price didn't react immediately. It stayed range-bound for years. Then it did react. And when it moved, it wasn't subtle. Same pattern we're seeing today. Western institutions exiting or staying flat. Eastern institutions accumulating without regard to short-term price. Or look at 2008. Gold sold off hard in the initial liquidation phase when Lehman collapsed. People called it a failure as a safe haven. They said it proved gold couldn't protect you in a crisis. But the buyers never left. They absorbed every ounce of supply that hit the market. And within a few years, it wasn't even the same market. Gold went from $700 to over $1,900. Why? Because the fundamental picture hadn't changed. The liquidity crisis passed, but the currency concerns that drove accumulation didn't go anywhere. They got worse. Silver showed the same pattern in 2020. When COVID hit and everything sold off, silver dropped faster than almost anything else. Paper collapsed first. Futures went into backwardation. But physical premiums exploded later. You couldn't find silver coins at spot price anywhere. Dealers were sold out for months. The paper market said silver was worth $12. The physical market said try $20 if you can even find it. When you zoom out, the larger story is always about who absorbs supply when forced selling hits. And the people absorbing supply in those moments are rarely wrong in the long run. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. China could slow purchases next month. Industrial demand could soften if global manufacturing weakens. Futures markets could stay under pressure longer than anyone expects. And they have before. And let me be honest with you, not every divergence resolves quickly. Sometimes price pain comes first. Sometimes it lasts longer than it feels like it should. You could buy into this thesis today and watch your position go red for 6 months. That's possible. But here's the thing about the manipulation narratives you hear in comment sections. You don't actually need them. You don't need secret meetings or shadow plots or theories about suppression. You just need incentives. Futures markets reward leverage and short-term volatility. Physical markets reward patience and long-term positioning. Watching which one breaks first tells you a lot about where the real stress is. And right now, the stress is in paper, not physical. That doesn't mean manipulation. It just means structure. There are probably 3 types of people watching this right now, and I want to talk to each of you directly. The first is already in metals, and you're feeling uneasy. You're watching red screens and wondering if you missed something. Maybe you bought in recently and now you're down. Maybe you've been holding for years, and this feels like déjà vu. Here's my take for you. Volatility doesn't invalidate a thesis. It tests it. If your reason for holding was long-term currency debasement or reserve diversification or industrial supply constraints, none of that changed this week. What changed was short-term sentiment and leverage levels. Focus on flows, not feelings. Watch whether the physical buyers stay active. Watch whether premiums hold or collapse. That's your confirmation, not the futures price. The second type isn't invested, but you're curious. You see the chaos and you're asking, is this an opportunity or a warning? Should I be buying this dip or staying away? For you, the lesson is pattern recognition. Don't chase price. Watch how physical demand behaves when price falls. If premiums expand, that's your signal that the market is tighter than the futures price suggests. If delivery times stretch out, same thing. If central bank buying continues through volatility, that's accumulation behavior, not trading behavior. You don't need to act today. You need to watch and learn the pattern so you recognize it next time it shows up. And the third type doesn't care about metals at all. You're here because you want to understand markets better. Maybe you trade equities or crypto or real estate. For you, this is a masterclass in structure. Paper can move fast because it's leveraged and liquid. Reality moves slower because it's physical and finite. Price eventually follows reality, but the gap between them can persist longer than you'd think. Understanding that gap is how you stop getting shaken out of good positions and how you avoid getting trapped in bad ones. This applies to everything, not just metals. So here's what I want you to answer in the comments. Which type are you? Are you holding and reassessing? Are you watching and learning? Or are you here for the market education? Let me know, because I read every comment and it helps me understand what you need to hear next. Here's where I stand, and I'm going to be completely transparent with you. I'm not pounding the table for instant upside, and I'm not panicking about the sell-off. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether China's reserve data stays consistent after this volatility. If they report another month of additions in their next update, that tells me this wasn't a blip in their strategy. Second, I'm watching physical premiums and delivery stress in silver. If premiums start expanding while futures stay weak, that's the divergence confirming itself in real time. Third, I'm monitoring whether futures selling exhausts itself without collapsing real demand. Open interest, positioning data, delivery requests, all of it matters. Based on my analysis, this move was mechanical, not emotional. It was structural, not random. The fundamental picture for metals hasn't changed. You've still got central banks buying. You've still got currency debasement across every major economy. You've still got supply constraints in silver that nobody's solved. You've still got geopolitical fragmentation pushing countries toward reserve diversification. None of that disappeared because futures traders had to cut leverage. If history rhymes and the physical buyers continue absorbing supply while paper markets shake out weak hands, the move that follows could make this sell-off look like noise. I'm not saying that happens tomorrow or next month. I'm saying the setup is there. The pattern is recognizable. And the people positioned for it aren't the ones watching 5-minute charts. I'm not a financial advisor. This is not financial advice. Do your own research, verify everything I've said, and make your own decisions based on your own risk tolerance and time horizon. But if you made it this far, you're the kind of person who thinks critically and doesn't just react to headlines. That mentality will serve you well, no matter what happens next. If you found value in this breakdown, share it with someone who needs to see it. Subscribe if you want more pattern recognition and market structure analysis. And stay ahead of the noise, because that's where the real edge is. Stay sharp out there, think critically, verify the data, and make your own decisions.